Inflation is one of those economic forces that most people don't think about in detail until it starts to bite into their everyday lives. In a stable economy like that of the United States, inflation typically hovers around 2% annually, a rate considered healthy by the Federal Reserve and economists. But imagine a scenario where inflation rockets to 10% and stays there for a prolonged period. Prices for everything, from your morning coffee to housing, would climb dramatically year after year. Wages might rise, but would they keep up? Savings would lose value rapidly, investments could shift dramatically, and the psychological toll on consumers and businesses alike could reshape the entire American way of life. Let's dive into this alternate reality, exploring not only how such an inflationary shock could happen, but also the ripple effects across every sector of society. To begin with, we have to understand what a 10% inflation rate actually means in day-to-day terms. Inflation is essentially the rate at which the general level of prices for goods and services rises, eroding purchasing power. At 10%, something that costs $100 today would cost $110 next year, $121 the year after, and about $133 the year after that. Over just 5 years, the price would climb to over $160, a 60% increase. This compounding effect means the cost of living would rise much faster than most people are accustomed to. For those with fixed incomes or stagnant wages, the pressure could be intense. The causes of such an inflation spike could vary. It might come from excessive money supply growth, perhaps due to aggressive stimulus spending or a central bank policy gone wrong. It could result from severe supply chain disruptions, as seen during the COVID-19 pandemic, but on a far larger scale. Or it could be triggered by a geopolitical event, such as a major conflict that disrupts global trade in oil, food, and other essential commodities. Once inflation expectations take root, meaning businesses expect prices to rise and raise their prices preemptively, and workers expect higher costs and demand bigger raises, the cycle can become self-reinforcing. The most immediate and visible impact of 10% inflation would be on consumer prices. Grocery bills would climb sharply. Basic necessities like milk, bread, and meat could cost substantially more from year to year. Gasoline prices would also rise, and because transportation costs feed into the price of nearly every product, this would drive further price increases across the board. The shock would be especially severe for lower and middle-income households, as they tend to spend a higher portion of their income on essentials. Housing markets would feel a dual impact. On one hand, home prices would likely rise quickly, as real assets tend to appreciate during inflationary periods. On the other hand, mortgage interest rates would likely soar as the Federal Reserve tightened monetary policy to combat inflation, making it harder for buyers to afford loans. Renters could face annual rent hikes of 10% or more, creating significant housing insecurity in urban areas. For homeowners with fixed-rate mortgages, their monthly payment wouldn't change, but property taxes, insurance, and maintenance costs would escalate. The labor market would undergo its own transformation. Workers would demand higher wages to keep up with rising prices, and unions might experience a resurgence in power. Some industries could face labor shortages if wages failed to keep pace with inflation. Employers, in turn, would pass these higher labor costs onto consumers, fueling the inflationary cycle. Businesses unable to increase prices fast enough might cut staff or close entirely, leading to higher unemployment. In this way, inflation can sometimes create a paradoxical mix of rising prices and economic stagnation, a phenomenon known as stagflation. Investment strategies would shift dramatically in a 10% inflation world. Cash savings would lose purchasing power quickly, so people would look to move money into assets that can keep pace with or outstrip inflation. Real estate, commodities like gold and oil, and inflation-protected securities would become more attractive. Stock markets could be volatile. Certain sectors like energy or consumer staples might thrive, while others, such as tech companies that rely on cheap borrowing, could struggle. Bond markets would be especially hard hit, as rising interest rates would cause existing bonds to lose value. The Federal Reserve's role in this scenario would be pivotal. In an effort to tame inflation, it might implement aggressive interest rate hikes, making borrowing more expensive across the economy. This could slow down consumer spending and investment, helping to bring prices under control, but at the cost of slower growth or even a recession. Monetary policy would become a high-wire act, with the Fed trying to cool inflation without triggering a deep economic downturn. On the fiscal side, the federal government would face unique challenges. Debt servicing costs would rise sharply as interest rates climbed. Programs like Social Security, which are indexed to inflation, would see automatic spending increases, putting more strain on the budget. Tax brackets might need more frequent adjustments to prevent bracket creep, where inflation pushes taxpayers into higher brackets without an actual increase in real income. Politically, these pressures could lead to intense debates over spending priorities and economic policy. Social impacts would also be profound. Inflation often exacerbates inequality, as wealthier individuals can shield themselves with appreciating assets, while poorer households struggle with rising costs. This could fuel social unrest, protests, and political polarization. Trust in institutions, from the Federal Reserve to Congress, could erode if people felt leaders were failing to address the crisis. Communities might see shifts in population as people move to areas with lower costs of living. Family dynamics could change as multi-generational households become more common to share expenses. Globally, a sustained 10% inflation rate in the United States would send shockwaves through the world economy. The US dollar, as the dominant reserve currency, plays a central role in global trade and finance. Persistent high inflation could undermine confidence in the dollar, leading other countries to diversify their reserves into other currencies or commodities. This could weaken the dollar's value, further increasing the cost of imports for Americans and potentially fueling more inflation. International investors might demand higher returns to hold US assets, affecting everything from treasury bonds to corporate debt. Trade relationships would be tested. US exports could become more competitive abroad if the dollar weakened, boosting certain manufacturing sectors. However, the cost of imported goods, from electronics to raw materials, would climb, squeezing businesses that rely on global supply chains. Emerging markets linked to US demand could see their own economies destabilized if American consumers cut back on spending. In the cultural sphere, prolonged high inflation could influence everything from consumer habits to entertainment. People might dine out less, travel less, and cut back on luxury purchases, affecting industries like hospitality, tourism, and retail. The psychology of inflation can be powerful. When people expect prices to keep rising, they may rush to buy goods before costs go up further, ironically feeding the very problem they fear. Over time, the concept of a good deal could shift dramatically, with consumers adapting to a world where price increases are the norm. Historically, the United States has faced periods of high inflation before, most notably in the 1970s when oil shocks and loose monetary policy drove inflation into double digits. The eventual solution, under Federal Reserve Chair Paul Volcker, was to push interest rates to historic highs, causing a severe recession but ultimately breaking the back of inflation. A return to such conditions today would be a daunting prospect, given the size and complexity of the modern global economy. Yet, in this hypothetical, we must also consider the potential silver linings. Some debtors, especially those with fixed-rate loans, would benefit as the real value of their debts would erode over time. Certain industries, particularly those in commodities, agriculture, and energy, might experience windfalls as prices rose. Savvy investors could find opportunities in inflation-hedged assets. And if policymakers manage the situation carefully, inflation could be brought down over time without catastrophic economic damage. Ultimately, a sustained 10% inflation rate in the United States would be more than just an economic challenge. It would be a societal transformation. It would test the resilience of institutions, the adaptability of businesses, and the resourcefulness of households. It would force Americans to rethink spending, saving, and investing habits that have been shaped by decades of relatively stable prices. And it would reshape the country's role in the global economic order. The question is not just whether America could survive such a period, it almost certainly could, but how it would be changed in the process. If this alternate reality ever came to pass, The experience would serve as a stark reminder of the delicate balance that underpins modern economies. Inflation at manageable levels can be a sign of healthy growth. Left unchecked, it becomes a corrosive force that eats away at prosperity. In our scenario, the lesson is clear. Vigilance, adaptability, and sound policy are essential to preventing the slow erosion of purchasing power from becoming a national crisis.